Okay, picture this. A software company growing its revenue by 53% year over year. A business operating with absolutely elite 84% profit margins, generating massive free cash flow, and sitting on a war chest of over $3 billion. Now imagine that exact same company reporting those numbers and immediately watching its stock crash nearly 20% in a single day. That is exactly what happened to AppLovin on August 6, 2026. And honestly, this jarring disconnect between their exceptional fundamental growth and that brutal valuation reset, well, that's exactly where the massive opportunity lies. Wall Street is dealing with an absolute paradox here. Look at this. On one side, AppLovin's Q2 2026 GAAP net income literally surged by over 54%. But on the other side, a violent 19.6% sell-off. So what happened? Did the underlying business model just break overnight? Or is the market fundamentally mispricing how artificial intelligence actually scales? To figure out who is right here, we need to look under the hood. Because if you haven't been paying attention, this is not the same company it used to be.
Right, so AppLovin is no longer just that mobile gaming studio you might remember. Back in June 2025, they strategically ditched their legacy apps business and transformed into a pure-play, extremely high-margin ad tech software company. And the beating heart of this entire operation, it's something they call the AXON engine. This is their proprietary, predictive machine learning engine. It optimizes ad spend in real time, hitting exact performance goals for advertisers. But here is the real kicker. The reason AXON is arguably one of the most powerful pieces of tech in the ad space right now. It effectively bypasses Apple's incredibly strict privacy tracking, the IDFA. Since Apple basically blocked personal user identifiers, AXON uses deep learning to match ads based purely on contextual data and predictive accuracy. It's brilliant.
And that brings us to their Moat. This is a structural, closed-loop data flywheel, and it is incredibly sticky. Here's how it works. It starts with the massive volume of ad impressions brokered across their network. Those impressions generate contextual interaction signals, which feed straight into the AXON prediction model. As the model gets smarter, the advertiser's return on ad spend, their ROAS, goes up. And when advertisers make more money, what do? They pour more ad spend back into the platform, which, you guessed it, feeds the engine even more data. Because it takes over 90 days of performance calibration for a publisher just to switch to a different network, nobody wants to leave. The flywheel just keeps spinning and getting smarter every single day.
Now, historically, AppLovin absolutely dominated user acquisition for mobile games. But the real story, the thing driving this next chapter, is a massive strategic push into the non-gaming e-commerce market. Management estimates this web-based performance ad market is 5 to 10 times larger than mobile gaming. Think about that. And they aren't just dipping their toes in. By Q 2026, AppLovin had already captured an 11% market share of digital ad budgets among direct-to-consumer e-commerce brands. They are actively stepping out of their gaming silo and stealing market share directly from walled gardens like Meta and Google.
So, if the tech is this good, and they're successfully expanding, what in the world spooked Wall Street on August 5th? Well, here are the exact numbers from that Q2 2026 earnings release. Top-line revenue grew nearly 53% year over year to $1.92 billion. But it barely missed the consensus estimate of $1.95 billion. Plus, normalized earnings per share came in at $3.97, just missing the $4.21 target. In a market that is pricing AI companies for absolute perfection, a slight top-line miss, combined with a sequential guidance deceleration for Q3, triggered an instant, brutal 20% haircut. But why they missed? That's the real story. On the earnings call, CEO Adam Foroughi dropped a line that explained everything. He said the miss was due to a lighter-than-normal cadence of AXON model performance improvements during the quarter. Let's break down the bear case here, because honestly, it makes sense. AppLovin's advertisers are 100% performance-driven. When the AXON AI model updates pause or even just slow down a bit, the advertiser's return on ad spend flatlines. And the second ROS flatlines, performance marketers instantly freeze their budgets. Wall Street saw this and completely panicked, assuming this AI growth engine had suddenly hit a permanent brick wall.
But here's the thing. AppLovin isn't sitting still. In fact, they are pouring fuel on the fire. Their research and development expense more than doubled, going from $44 million in Q2 2025 up to nearly $100 million in Q2 2026. They are aggressively expanding their AI infrastructure, computational hardware, and engineering teams to build the next massive leap for the model. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. Now, this heavy R&D spend definitely ate into short-term margins, which just added to Wall Street's anxiety. But AppLovin has a massive structural advantage that most hypergrowth software companies would kill for. They have the ultimate safety net. We're talking about a fortress of a balance sheet. AppLovin is sitting on over $3 billion in cash and equivalents, with a remarkably conservative net leverage ratio of just 0.1x trailing adjusted EBITDA. This massive pile of cash completely de-risks those higher short-term computational costs. They can absolutely afford to absorb the heavy expense of training new AI models without putting the financial health of the business in any danger whatsoever.
Moving on to our qualitative scorecard, a look at the business quality assessment.
Based on the underlying research, AppLovin lands a solid blended score of 8.6 out of 10. But let's actually synthesize what's driving that, rather than just reading down a list. The absolute standout here is profitability. That's a perfect 10, thanks to those elite 84% adjusted EBITDA margins we talked about. Capital allocation is also fantastic, scoring a 9, driven by management's flawless transition away from legacy gaming into a pure-play software business. But we have to call out the pressure points, right? Analyst sentiment took a hit, dropping to a 7 due to those near-term downgrades after the Q2 print. And management alignment sits at an 8. While CEO Adam Forhuji's founder-led vision is a huge asset, there has been a massive wave of insider selling, literally nearly $372 million worth of open market transactions over the last 6 months. It's definitely a factor weighing on the score and something we have to keep an eye on.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. Premium also includes Portfolio Watch to monitor your portfolio and flag important changes, and Insider IQ to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video, scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, let's get into the 5-year valuation scenarios, a hypothetical framework.
Now, before we start, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Let's walk through the math. In our base case, which holds a 55% probability weight, we assume core mobile gaming remains stable and e-commerce adoption grows moderately. Operationally, this requires a 20% revenue compound annual growth rate over 5 years, reaching roughly $20.4 billion in year 5. Applying a very conservative 18x price-to-earnings multiple, we get an implied future share price of $637.80. But look at the high case, weighted at 25%. This scenario assumes rapid, successful self-serve scaling within the massive e-commerce and connected TV markets. This requires a 30% revenue CAGR. Because it's a software model, at that scale, net profit margins could push to 55%. If the market awards a 25x PE multiple for that elite growth, the implied future share price rockets to $1,531.28. And in the low case, modeling a worst-case growth decay and a multiple contraction down to 12x, we see a drop to $198.80. But honestly, driving the bullish scenarios is a hidden engine operating quietly in the background.
21.62%. That is the percentage of total company shares AppLovin has repurchased and completely retired since 2022. Because their capital expenditures are incredibly low, projected at just $10 million annually, almost all of their operating income converts straight to free cash flow. And management is systematically directing this cash into aggressive Class A share repurchases. This structurally forces long-term earnings per share to compound simply because future net income is being divided among a rapidly shrinking number of outstanding shares.
When we take those 5-year valuation scenarios, the high, base, and low cases, and mathematically weight them by their respective probabilities, we arrive at a blended expected value target price of $773.37. From current trading levels, this implies a massive 20.28% annualized total return over the next 5 years. And remember, if you want to dig into this, you can see the full, detailed financial model with every single assumption driving this math for free on Flash.
Now let's look at the structural risks and what could break the thesis.
A rigorous framework demands that we look at what could actually destroy this asymmetric setup. The most immediate, existential threat here is platform policy changes. AppLovin relies entirely on iOS and Android to distribute its software and collect those contextual signals. If Apple or Google suddenly rewrite privacy rules to restrict contextual SDK tracking, it acts as an absolute choke point, degrading the AXON algorithm's accuracy. We also have to watch creative bottlenecks. Expanding into e-commerce sounds amazing, but direct-to-consumer brands require continuous new video assets to feed the algorithm, sometimes 10 to 15 fresh variations per campaign. If mid-market brands struggle to produce enough creative assets, programmatic ad volume will choke. Finally, corporate governance. Supervoting Class B shares grant CEO Adam Foroughi and insiders 66% absolute voting control. Basically, if you buy this stock, you have zero say in how the company is run.
Which brings this whole story back together. The 20% stock crash was triggered by a slight delay in AI model performance updates, which caused advertisers to momentarily pause their budget increases. So the big question? Is Wall Street mispricing a short-term AI model pause as long-term decay? The evidence points to yes. Crucially, management confirmed that the next significant AXON update iteration was actually already deployed early in Q3. That deployment is the immediate catalyst expected to re-accelerate ad activity and challenge all this market panic. This isn't a broken business, it's a highly profitable, cash-gushing AI machine that simply experienced a brief, totally natural delay between software updates.
So the real question is, will you capitalize on Wall Street's panic, or is this AI pause an early warning sign of a broken flywheel? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.